Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend Podcast. Today is Friday, December 16th, 2022. S&P 500 currently sitting at 38.36. I'm David Zarling. Ian McMillan is on a well-deserved Christmas vacation heading to Pennsylvania. I'm here with Kevin, 2008 Headphones Ferrari, and Dan Beta Bronco Gorkuber. Gentlemen, thanks for joining me and doing this.
Good to be here.
Yeah. It's like going back in a time machine listening through these headphones.
Yeah, I was going to say, does it take a while to get there?
No, that's not too bad.
Okay, so it's not like a styrofoam cup with wires, and so you're just hearing what I just said now, and there's a major delay.
It's not the soup can with the string. No.
Okay.
It's a little more advanced than that, but not much.
Do they run on diesel, or how are they powered?
I don't even know. Probably don't even want to know.
That's fair.
I'm just impressed that I haven't lost them by now.
Oh, that's good.
It's because they have one of those headphone holder strings you can get like for your AirPods now.
Oh, yes, I see those where they actually attach the ends of the AirPods.
Yeah, we're literally starting to go backwards in innovation. We've had this for how long? You just put a cord on something.
Yes, we've had earbuds with cords before, and now they're attaching them to AirPods. It's hilarious. Mm-hmm. Oh man, too funny. So there's plenty to cover. Lots of price action between last week and this week. Any place you guys would like to start in things that you've noticed, whether it's over the past week, past month, it can be. We'll let you guys take this wherever you guys want to go. Don't all jump at once.
I can see the eye contact through the screen.
It's not Dan. Take the layup.
Take the layup. Yeah, start with something.
Might as well start with S&P 500 levels.
Yeah, for sure.
I mean, I think we've kind of beat it over the head multiple times this year, but it's still within a general downtrend with these markets. And just kind of looking here in the intermediate term, you're probably kind of focusing in on like that 39.20 zone to 39.50 as something that is very important in the near term to intermediate term to reclaim. And then conversely to the downside, I mean, the world is your oyster.
Yeah, it's I don't know what the opposite of clear skies would be, right? Because clear skies would be to the upside. Maybe to the downside would be clear ocean. I don't know, but your point is valid. The price range that we had going back to the beginning of the month, back to November 10th, let's say, all that price action actually happened below 40.80 on the S&P 500. And that the reason why that was important is because between 40.80 and 41.80, that 100-point range, very crucial level that goes back to May, June, earlier this year, where that was a retest level. Retest meaning we broke below it in May, retested, came back up, retest that level, and then that's when things started to get really hairy from a broad market perspective. And you're right, we remain in an intermediate term time frame downtrend, intermediate term being defined as weeks to months. We had been in a daily days to weeks, so near term time frame uptrend, a counter trend move. And I think it's safe to say we've broken that rate of trend.
Yeah, and especially, you just mentioned rate of trend. Like if you look at that rate of trend on a more longer term, like end of December 21, January 22, I mean, we touched that twice over the past couple of weeks and really even came up to try to break above the 200-day and couldn't do it.
Right.
I mean, everything kind of converged in this kind of area here.
For sure. And last week we talked about, is it really that easy that we come into the 200-day and roll over? And maybe it is. We have to wait for more information. But one of the theses we were operating under was a tactically bullish in an intermediate term, weeks to months, bearish environment. Meaning as long as we're above 3,667 on the S&P 500, there's a bullish scenario in place that's happening within a intermediate term bearish downtrend. But now we've broken this rate of trend that goes back to mid-October. Everything is in the court of the sellers. All the evidence points towards sellers having control. The bear market downtrend remains. And so really that thesis is in full effect below is 39.25 a fair, as long as we're below 39.25 on something like the S&P 500, sellers have control.
Yeah. Yes, they do.
And I would say, go ahead, Kevin.
I would say now too, where prices below the 50-day today. So, let's see where it closes. I mean, it can happen here, but.
Oh, you're saying the S&P 500 below its 200-day, but also below. Yeah, you're right. Below its 50-day.
Yeah.
And so we'll see where we go from here. A lot of people like to talk December as being having positive seasonality. And that could be the case. We could see that happen. This is also notable. This is where we would want to sit up and take notice that if between now and the end of the year, stocks remain weak, that we want to pay attention to that. That in a seasonally bullish period, stocks are actually weak. That's something definitely we need to sit up and take notice of. And where are we seeing all this? When we look at, right, because it's not just a stock market, it's a market of stocks. And sometimes people think, okay, well, when we talk stock market, they think of the Dow Jones or they think of the S&P 500 or they think of the NASDAQ, and those are good and they're great. But what are we seeing? We could either point to sectors or we can point to individual stocks. What are we seeing underneath the surface that's worth paying attention to? It could be relative weakness. It could be relative strength. That's notable. Anything you guys are looking at that regard?
Let's say if you want to stick to like under the surface of S&P, at least recently, we've kind of been talking about, if you think a lot of the kind of overweight sectors, areas kind of in the S&P, so like your tech or like FAANG names, kind of some of the more important ones like they really kind of been getting hit this week.
Oh, and so when you say overweight, you just mean as a percentage of
names like Apple, right?
As a percentages of the S&P.
Mm-hmm.
So for example, technology is about 26% of the S&P. And when we look at performance over the last month on that sector, it's the worst performing sector.
Yeah, it isn't good. It's no bueno.
Whereas on the flip side, for the last month, healthcare, utilities, and staples are the best performer in the S&P 500. And that's not really saying much because those are defensive areas of the market. So we're seeing risk on areas of the S&P 500 falter and risk off areas of the S&P 500 do well. But doing well is relative, right? Like we don't get to sit at, like utilities or staples would be a good example. I believe staples are breaking out on a relative basis. What I mean is you take something like XLP versus the S&P 500 and you're breaking out to price levels we haven't seen since 2020. While that's nice, XLP itself is also getting sold. Staples are also getting sold pretty hard today. It just so happens they're dropping less than the S&P 500. And that's information. That's risk off information.
Yeah, really you're seeing that kind of all over the board, right? Like healthcare, you're just talking about kind of the same deal of relative. I mean, it's been outperforming the S&P essentially for the past, month?
Mm-hmm.
But yeah, on an absolute basis, I'm getting hit pretty hard.
Well, do we really get to be surprised where healthcare using something like XLV is finding resistance?
I can't get much clearer than that. Up around like, what is that, about 140, 142, somewhere in there, roughly.
Right. I could think of a great band name that also is appropriate for this, and it's overhead supply. Like that.
That's a band?
Well, no, it's not, but it should be.
No.
If we ever started a band, I think we call it overhead supply.
Maybe
I'm sure, I'm sure there's lots of dual purpose names for technical analysis that we could use for a band name. Be awesome. Bullish engulfing. I have no idea, but overhead supply sounds pretty nice. And there's plenty of it in XLV healthcare. And so here you have an area of the market that's risk off, that's reversing at the 140 area. That makes a lot of sense where that's happening. What about utilities? Because we talked staples, we talked healthcare. Utilities is an interesting one.
Yeah, you have this like 72 area where they tried to get above just on like something like an XLU. Spider Select Utilities Fund.
And it's right at its like pre-COVID highs.
Yeah.
That $70, $71 level. It's below a 200-day moving average. It's been a hot mess. If you look at something like XLU, and the reason why I say hot mess is you're really talking about a almost close to a 20% range that goes back to the beginning part of the year. So utilities have been vibrating in a 20% range since the beginning of the year. Not exactly healthy price action from something that's considered a safe haven. It sounds like purgatory. Like, hey, congratulations, you've been assigned trading utilities in a 20% range for a year. Doesn't sound great.
Oh.
So do we want to stay on equities, or is there anything that we should be pivoting? Like, we could pivot to commodities. We could talk about,
Just on like
go ahead.
More on the overhead supply kind of bandwagon. I mean, we're seeing that a lot in some of the bigger crypto areas too this week where
Dan's going to crypto. I love it.
Sorry, we knew it. We can wait on it too.
No, this is great. I love this.
But yeah, where you just, I mean, on something like Bitcoin, you know, you're trying to trade back up into, I don't know, call it 18,000, 18,500.
Mm-hmm.
And, you know, clear breakdown level of previous support for a while there. And, you know, technical analysis 101, where we come and revisit it, you get the retest and you sell off, you know.
Yeah, pretty swiftly, right? You talk about that 18,003, 18,005. We touched there and reversed pretty quickly in something Bitcoin versus the dollar. And that's that overhead supply. Am I painting that picture correctly, Dan? That you're talking
Monet
painted. It is. It's I mean, it's pretty clear. And part of me, I don't know that you can get very fundamental about crypto, but when you think about what's going on in crypto with the recent arrest of Sam Bankman-Fried in the Bahamas to be extradited to the United States, the collapse of FTX, the second largest crypto exchange on the planet, part of you wonders if Bitcoin was or is the safe haven, because it's down the least when you think of all the crap coins. I'm not saying Bitcoin's a crap coin. I'm saying there's a lot of other tokens and coins out there that are down anywhere from 70 to 90%, and Bitcoin and Ethereum, and I think justifiably so, are not down that much. But then you wonder where this all goes in the days and weeks ahead, because we're not out of the woods. We don't know what's going to come out of the FTX saga at all. So your point is totally valid about this overhead supply at 18.3, 18.5. I think Ethereum falls into that same boat, a crypto boat, which I don't even know what a crypto boat would be made out of, but that also finding resistance at the 1300 level. And these remain in broad downtrends as well. And so do those continue, and does the news get worse? I remember a podcast he and I were doing where we just talked about how you could see Bitcoin at 10,000 and it would just be weeping and gnashing of teeth. Things would be just absolutely terrible. And maybe one of those scenarios is Binance goes under, the largest crypto exchange. That's not even an allegation. I don't know, but I do know that there appears to have been some crypto printing going on. And I know enough, I've been around the markets enough to know that that's a problem when you have something, or rehypothecation, right? Lending Bitcoin to other several times in a row to other people can be a problem. So we'll see where that all unfolds, but crypto definitely in a dangerous territory, which maybe we could talk about the original crypto, the original dollar. What about the dollar? What are we seeing out of trade weighted dollar, any dollar pairs? Last week, we talked about how dollar's been down, but yet equities are flat to down. That was supposed to be a tailwind. What are we seeing out of things like DXY or any currency pairs?
I mean, if you just look at DXY on its own, I mean, I know it's been, around the like 104, 105 level that we've talked about. I don't know probably how many times on this podcast in the last couple of months, pretty much holding there, at least last kind of few days. And if you look at kind of some of the more common like foreign currency baskets, you're kind of seeing the opposite as you would expect, kind of almost like we've been talking about with other asset classes, kind of getting to levels of where you would expect overhead supply resistance, and they're kind of looking like they might turn around here.
Would an example be something like FXB, which is the British pound equivalent of DXY?
Yep, I mean, that would be a good example there. Perfect, yeah.
So overhead supply at 118 on that relationship. So here it had been sold off pretty hard. In fact, people might remember, I believe there's a new prime minister as a result of how bad the British pound had performed based on that. And I'm probably, as an American, I'm probably oversimplifying things there. However, we saw the British pound sell off pretty hard. And now we're back at the 118 level, which is what we would call polarity, a level we visited in 2020, 2019, 2017, 2016. It's a common level, this 118, using something like FXB. We're back into that level. And do we see resistance here? Do we see overhead supply take over? That's a great point. I think FXE, the Euro currency trust, same thing, nearing a level of potential overhead supply.
Yeah. I'm saying actually that one almost might be even clearer when you look at it. FXB actually tried to break above that level, and it's maybe a little messier, but FXE, I mean, it doesn't get much simpler than that.
Right. And I know earlier this week, Dan, you shared a currency cross, and I believe it was the Australian dollar. And was it just
Aussie
versus the US dollar?
Aussie versus the euro.
And what are we
dollar versus the euro. So
yeah, what are we seeing there?
Some pretty decent breakdown there yesterday occurred from a nice, I don't know, what do you call that? A 1.5 month consolidation type of leg.
And does that relationship have any meaning as far as because I know when I think of the Australian dollar, I think of mining or precious metals, very commodity impacted.
Yeah. Yeah.
Do we see any type of relationship there? And it's okay if we don't. I'm just curious when we look at something like that because it is you could tell it's an important breakdown. And when I look at, let's just say gold miners, for example, talk about using something like GDX around the $29, $30 level. Again, overhead supply, meaning, and what do I mean by overhead supply?
Yeah.
I should actually describe that for those listening. What that means is when you sell off from a price level and then you revisit that level, human nature says, I'm back to even, I'm going to sell again. And so it's supply entering the market at a previous price because someone just got back to even, or a large group of people just got back to even. It's a human nature thing. People do it all the time. I just got my money back. I'm just back to even. I'm out. Because there was a lot of pain that happened between, for example, if you owned GDX at $29 back in June and you just experienced a move that dropped 23, 24%, and you get back to even, you're out. And that's kind of what we have in place for something like GDX. But I don't know if Australian dollar versus the euro has a type of relationship like that.
I guess I'm not familiar if there would be one or not, but I could definitely see just by kind of understanding the flow of the trends in this pair. I mean, if you want to be bullish the markets, whether it be metals or even just overall risk on in equities to some degree, I mean, you probably want to see this pair move up and to the right on a chart.
Which we're seeing the opposite of.
Yeah, versus right now we're down into the right. So
no, that's fair. So we talked crypto, rolling over, overhead resistance, overhead supply, some currency pairs now bumping up to overhead supply, the trade weighted dollar at a very important 103, 104 level. If that holds and moves higher, potentially a headwind for equities. Let's pivot to bonds. What are we seeing in the bond complex?
I think if you talk, kind of like we've been talking about here, like the past month or so, bonds have kind of been showing some life. At least they're kind of twitching a little bit, right? And then you're kind of getting to the same story here, starting to reach areas where you could potentially see overhead supply. Like if you look at TLT, like the 110 area, we've kind of just been hanging out here, kind of getting rejected a few times. And then AGG, kind of the same story, more around 100. And there, you're kind of getting close to like the 200-day too.
Right. And the aggregate bond, AGG aggregate bonds, that's one of those instruments, right? It covers more than just treasuries. It has your corporates. It has several, it's a fun word to say, tranche, several tranches of different types of bonds. The way to think about that would be different slices. So in that loaf of bonds, you've got treasuries, a slice of treasuries, you've got a slice of liquid corporates, you've got a slice of high yield, but mainly your AAA or higher type credit instruments inside AGG. And interestingly enough, I'm going to be off by 1 or 2 years here, but I believe since its inception, AGG has only been negative 1 or 2 years, and 2022 is setting up to be one of those years. So a really unique time for bonds overall, and using something like AGG returning to the 99, 100 level, there's some price history here. So we'll see where that plays out. But bonds definitely since the beginning of November have done better than stocks. Even if you just use a relationship like AGG versus S&P, it's in a range. That relationship hasn't gone anywhere since the end of last year, which is also a testimony to how much bonds have corrected. If you think about that, so AGG is equivalent to stocks. So broad market bonds equivalent to broad market stocks since the beginning of the year. That means, right, if the S&P is down anywhere from 15 to 25%, depending on what period of time you look at, to have aggregate bonds down that much is pretty significant. But we appear to be looking at a potential where bonds are actually acting like a risk-off proxy, where people are buying bonds as a risk-off element. And I think there's a lot more time to determine whether that's true or not, because we're really talking about a bounce at this point. You mentioned AGG being back to a 200-day. TLT eclipsed 102. That's important, but really not out of the woods for bonds by any means.
Well, and like if you look LQDs, like your investment grade corporates that touch 200 days, start rolling over, even like HYG or like your high yield or J&K junk bonds. HYG touched 200-day, rolled over. J&K didn't quite get there, but got close. So kind of a lot of similar characteristics kind of across all those different bond types.
Yep. So bonds definitely not out of the woods.
Mm-hmm.
And kind of related to that, right? Because bonds up. If you think about it as a teeter-totter, actually, I should be careful here because teeter-totter, that might be a generational term for me.
Yeah, that's actually a good point. I don't know the last time. Well, I guess I don't sit there and go to playgrounds really anymore, but you don't really hear about that, do you?
Yeah, like teeter-totters. I can't even think the last time I saw a teeter-totter. But I'm hoping most people listening to this know exactly what a teeter-totter is. And if you see one, maybe I am going to pull over on the side of the road if I see one. But they're not really fun by yourself. Kind of a awkward scenario.
Hard. Yeah.
Awkward scenario. But if you think of bonds and rates as a teeter-totter relationship, right? Bonds up, rates down. And so here we are in an environment where bonds have bounced. So that means rates have broken down a little bit. And when we do our homework, we know that the shorter the duration, sometimes I would describe it as the more leading it is. And what I mean is you typically see the 2-year yield break before the 7 to 10 year, which breaks before the 20 to 30 year yield. And so we have the 2-year yield trying to hold it together at 4.2, and it's below its 50-day moving average. And so we'll see if that continues. But related to that, right, when we think of lower rates, sometimes people like to focus on banks. What are we seeing out of banks and financials?
Pretty downtrendy type behavior. Taking something like regional banks, like a KRE, testing the lows here even today from July. Those July, what day was that? July 14th.
Yeah, look at that.
It was on that day, but the closing price on that day starting to test that. So
what I find interesting, using your example of regional banks, KRE, is when we do our work of what does leadership look like off of market bottoms. An example of that process would be if October 13th was to mark a major market bottom. So let me say that again. If the S&P 500 on October 13th was to mark the market bottom, that's a lower low for the S&P than June, middle of June 16th, 17th. What's interesting is KRE in October was marking a higher low than in June and July. And here we have it breaking its October low, meaning it had the potential to be a leader out of this, and it's failing. And anytime you see financials failing on a relative basis, it carries a different significance than staples or utilities. It's not that financials have to outperform, but if they are moving to the downside and they're moving to the downside faster than the S&P, there's some problems there. It's a little bit of a canary in the coal mine scenario, where if your regional banks are rolling over, which had been stronger than financials overall, and now it's right at a critical level versus something like XLF. I mean, it just seemed like they had the ball on the goal line and they fumbled it. And regional banks can't hold it together. And here we are several months later, and they're starting to lead to the downside. And it's in an environment where we might be seeing, wouldn't it be interesting to see bonds continue to rip higher, rates fall off? And this goes back to the thesis that the bond market sets rates, not the Fed, that within a very, very short period of time, the Fed is pivoting to lowering rates. TBD. So when we think about risk on, risk off, or high beta, low beta, or low vol, when we think of leadership that led us into 2022 that's now failing, I think of FAANG stocks. What are we seeing there? And maybe if you guys could describe, right, because I'm not talking about teeth, FAANG stocks, what are we describing there?
We're describing like your the classic acronym, Facebook, Amazon, Netflix, Google, Apple. Well, the A could be Apple too, I guess.
Right.
Suppose
Apple, Amazon.
2 A's in there for the double FAANG, but yeah.
But it's your big cap tech, right?
Mm-hmm.
Basically, you describe Facebook, Apple, Amazon, Netflix, NVIDIA, Google, Microsoft, Tesla, and then you throw some Chinese big cap tech in there like Alibaba, PD, and Baidu. And that describes a basket of FAANG stocks. And here we see them rolling back over. More evidence towards further downside when your largest cap stocks start to fail.
Yeah, for sure. And especially with kind of mentioning some of those Chinese names in there, right? I mean, China's been kind of on a roll we kind of been talking about that about a month and a half. And you're kind of seeing them hit the same overhead supply area and also like a downward rate of trend. Some of those are starting to roll over as well. So even not necessarily just domestically, but abroad, some of the areas that were a little stronger, kind of running in the same issue, which then that kind of ties into FAANGs too with some of those Chinese names.
Well, that's a good point, Kevin. An example of that, when you think about the basket of FAANG stocks and then the Chinese big cap tech names that are in there, Alibaba, for example, from its low in late October, just to get back to the 200-day moving average, which it did just a couple of days ago, it had to move 56%. So from its October low to its 200-day moving average, 56%. And it's fixed nothing.
No. And I mean, yeah, just go up, touch 200-day, kind of hang there, and then roll back over. I mean, which really is wild to think about, that 56% move can essentially, I mean, it's just window dressing, right? It really means nothing at this point.
Well, and it's indicative of what we see in bear markets. You know, if we look at historical bear markets, we know that counter trend rallies happen all the time, and they're pretty big. You know, 2008, you had pretty significant rallies that happened during the bear market, and it's a reality. Markets don't move in a straight line, and when you go down the elevator, the vibrations that happen in the elevator are more dramatic than if you're going up an escalator. And so you have these bigger moves that happen, and BABA's quintessential. You got a 50-some% move, and all you've done is getting back to a sloping 200-day moving average and fix zero, nothing. And you're seeing this in a lot of areas of the market where we just experienced a counter trend move, and we only know it's a counter trend until afterwards, right? Like it always could be the start of a new bull market. And really, if we're going to see a start of a new bull market, what would you guys be looking for to say, okay, here's the evidence that continues to confirm a new bull market? You guys have any thoughts on that as far as what you guys would be looking for in that regard? It could be a price level, it could be a certain sector.
Yeah, I mean, I know when we brought this up before, and I think Dan too was kind of in the same boat. I think that you can confirm that, but I mean, I guess if you think of it textbook, you'd kind of expect bonds to recover and kind of lead at least initially off the bottom, or at least show some life. Which I mean, it's kind of interesting to see. We've been talking about like this past month. It looked like that might be the case, and now we're seeing, maybe not quite yet.
To that point, though, Kevin, when we look at stages of market expansion and contraction, stage one, which is you start to see the final phase of the equity correction, bonds actually do well.
Mm-hmm.
So in stage one, commodities and stocks are down and bonds are up. There's no evidence currently that refutes that thesis. Is that a fair way to say it? That we've seen equities drop since the beginning of November, bonds up since the beginning of November, and commodities down. So that's stage one behavior. So it's the final phase of market correction, which sometimes can be the most painful.
Mm-hmm.
You think of 08, 09, that final phase, like serious moves to the downside. I'm not calling for that, but we'll see. Anything else? What are you guys looking for if this isn't bear market behavior, but that rather we're going to see a resurgence into a bull market? What price levels, what sectors are you looking at to see a return to that?
I think to that point too of just like that stage one. Sorry to cut back in on it, but
do it, man. This is your show.
It'd be nice to see like some capitulation, just as kind of that last gasp. Bring out the real fear, the real selling, if you want to say, in terms of panic selling, I should say, or clarify.
Yeah, I think that's fair because there really hasn't been that.
Yeah. I mean, really, not really. I mean, maybe some like slight views of it, but not really. Not like we've seen in past historical events, I guess. So
we don't have to have that. It doesn't have to happen. But typically the throwing the baby out with the bathwater moment does tend to mark the very close to the end. And we really haven't had that. I get why someone could say, well, October 13th with the gap down on some information, and we rally, we make this huge rally.
Right.
Maybe, but I don't know that the volume profile is there. And not that volume's everything. It's really about price. And so you saw, when you think about the COVID bottom in March of 2020, that March 23rd, like the advancement of price to the downside was so ferocious.
Mm-hmm.
It's almost like you had this selling exhaustion. And that's really what Dan is kind of talking about, is this event where you just run out of sellers. You run out of people that are selling, and all that's left is buyers. I don't think we've reached that yet.
So, it's funny you mentioned that. So, like, if you look at some of these safety sectors, like healthcare individually, and kind of staples like the ones we've been talking about recently, have kind of had more like relative performance to the upside. I mean, like just XLV, when you start looking at some of these daily candles, like especially today, kind of makes you wonder if maybe we did, like in the last month, see kind of like that final flight to safety. And you think of like some of these people that have fund mandates, they have to stay invested in something.
Oh, I like this. I like what you're going with this.
Did you finally get to the point where people are positioned how they essentially have to be?
So Kevin, can I use this analogy?
Mm-hmm.
So this is a little bit like hide and seek, right? In November was the countdown, right? When the kid hides in the closet and he's yelling out loud while his friends go hide. That in November was the period where asset managers, and you said mandate. Can you describe what you mean by mandate?
Yeah, so this kind of varies across the industry, right? But like if you have some of these asset managers funds that within their, what's the best way to put it?
Their investment policy.
Right, policy, almost like rules of engagement, right? They have specific guidelines they have to follow and abide by, which could be they'd have to be X number percent invested at all times in equities. You can throw any number in there, right? 90, 95.
I was going to say, yeah, most of them are anywhere from 90 to 95%. You have to be invested. So think of XYZ fund. We can call it whatever we want. We call it the headphones fund. We call it the Beta Bronco fund. Whatever it is, they have to be invested 90 to 95% in equities. And your point is that they've
somewhere, right?
Right. They've spent the last month trying to move into the safest names. It's the hide and seek. In November, the countdown's begun. I'm moving into the safest areas for my fund. That might be Broadcom for semiconductors. That might be certain healthcare names in Europe if I'm a European fund, because I know you guys brought that up pre-call or pre-recording, just the makeup of European funds and how they're heavily tilted towards financials and healthcare, and where we're seeing strength over there. Where we're seeing strength out of semiconductors is in quality names. So was November and this first part of December a game of hide and seek where, to your point, using healthcare as your example, they piled into healthcare names, the safe havens, and now those are rolling over. Is that your point?
Mm-hmm. Yeah, and then you almost get to that situation like Dan was talking about now. I mean, they're essentially positioned where they can be, and now they just have to ride it out.
No, that's very fair. It's a great acknowledgement of how asset managers have to operate. And so you are seeing healthcare rollover, you are seeing staples rollover, you are seeing utilities rollover. So now are we going to see that correlation back to one? Meaning everything moving directionally the same. We had our counter trend rally. We had our move into safety, and now let the games begin. That's TBD, right? I think if we use the S&P 500, the real clue would be if we do truly eclipse that 3,600 level, 3,590 on the S&P 500. If you were to look at the Qs, which definitely didn't even approach its August highs, the Qs have been the weakest. So your big cap tech names have been the weakest domestically. If we're eclipsing like 260, 262 on something like the Qs, that's confirming that thesis that all November was a flight to safety before the game, like the real pain begins. That sounds really dramatic. I have no idea if that's going to happen. That's why we use price. But until we see something like 4080 or 4180 reclaimed on the S&P, it's guilty until proven innocent.
Yeah, because who knows? Maybe it's tax office harvesting, and Monday we're up 3%.
Yes,
so, I mean, it's
exactly.
kind of early, you know.
Right. Kind of have to stay agnostic. Just know that price knows more than any of us. Anything else from a bullish thesis confirming standpoint or bearish thesis confirming standpoint that you guys are looking at?
Nothing that I want to highlight here, I guess.
Yeah, no, that's fair.
Yeah.
Some things are best kept for the clients, and that's fine too. I think what's notable, I think it was 4 or 5, maybe more podcasts ago, we talked about the 200-week moving average, right? So Paul Tudor Jones always said nothing good happens below a 200-day moving average. And there's, some statisticians would argue against that and say, well, like below a 200-day moving average, we have, X amount of times that you actually see positive returns after that. I understand. I get it. But I also understand what Paul Tudor Jones is saying is that risk is increased. And when we look at risk metrics, when you look at a 200-week moving average, things dramatically increase in risk. And here we have the Qs breaking below its 200-week moving average for like the third or fourth time. And will it hold this time, which means real pain is about to begin. And same with small caps, also below its 200-week moving average. So we'll see. We'll see where these things end up. We've seen that international strength that Kevin and Dan have been talking about when we look at something like VEU, which is the all-world stock index, and you subtract out U.S. equities. It's still below its 200-week moving average and below its 50-week moving average. And so do we start to see everything roll over together? To be determined. I don't want coal in the stocking, but if there ever was evidence that it's happening, I think we're getting some information this week. Or am I being too dramatic, guys? You guys can push back on this.
No, I mean, well, like you're talking international, like if you look at EFA on weekly, I mean, that just came up, kissed 200 week, and then that's a pretty rough looking weekly candle. So I mean, that's like you're seeing kind of the same picture, at least roughly or generally, no matter where you look. It's kind of hard to feel warm and fuzzy about it.
Yeah, that's a good point. The only thing we'll be able to feel warm and fuzzy about is maybe just the true meaning of Christmas, because some of this looks like some broken markets. But again, I always get nervous when I think like that. So push back on me. What are we seeing? And it's okay to say I see nothing. I don't see anything from a thesis standpoint, right? Because that's how we should be thinking. We don't get to say I think this or I think that, because that's ego driven. It's more about here's the thesis, is price confirming or denying? And when I think about the bullish thesis, bullish thesis for equities, I don't see a lot of confirmation.
No, not on that side. I mean, kind of like we touched on bonds. It's kind of we've been seeing more signs of life, and now it's more of we're at like a point of hesitation where overhead supply might kick in, and maybe that kind of follows the same route as equities. And that one, I think you might have to kind of take until next week to find out a little bit more about that. But I don't know. For me, that would be the only thing that would give me hope, is if bonds hold out here, maybe just kind of consolidate a little bit or continue moving higher and feel a little bit better about that. But
Dan, how about you? Any thoughts there? Any pushback on Dave? Why are you so bearish right now?
No, I think nothing like too wild and crazy, I don't think. I mean, it's kind of just like we're waiting on some, like we know what we want to see. We're just kind of waiting on it to see if it'll change.
Right.
Like you said, I mean, yeah, we could point to some stocks seeing, breakouts and 52-week highs and whatnot, but I don't know, from an overall market perspective, it's tough to get too excited about it. Maybe you could lean on I mean, if you're somebody, maybe you could lean on like a Santa Claus rally. I don't know.
Right. Well, it just goes back to always challenging the thesis, and that's our job. But until S&P 500 is above 39.25, the bullish thesis is pretty much broken. I would say the same thing for the Qs above, like as long as we're below 280, it's problematic. And who knows, this could happen in the last 3 hours of today that we reclaim this. I'm not here to tell the market what to do. Something like small caps, it's interesting that we've gone through 174.50. I think you got to reclaim 181 on something like small caps. Something like all world VEU, it's interesting that it's shown the most strength. And so it wouldn't surprise me that if we continue to roll over here into a protracted bear, it wouldn't surprise me that whenever we develop a bottom or broaden out, that international would be a leader out of this, because the amount of clearance that's happened in something like international stocks is significant. So as an example, VEU, to get back to its October lows, has to move minus 14%. Whereas something like the NASDAQ 100, we're only just 5% away. And so my point is, you could see that if there's a bottoming process that happens, that the winners out of this is actually international stocks going forward, which I don't hear anybody talking about, which I kind of like. But we'll see. Price has to confirm that. Anything else? We're bumping up towards the end of our time. Anything else we should be touching base on before we wrap it up?
Nothing from my end, I guess.
All right, Kevin?
Yeah, I can't really think of anything else.
No, this is good. I appreciate you guys filling in while Ian's on the road. I appreciate you guys. You guys are tremendous analysts and ongoing ideation that goes on the adaptive team. So thank you for your insight and work today. We appreciate everybody listening. As always, if you like these, please give us high rankings and share it with your friends. It helps us get the word out, and we love it. Until we see you guys next week, have a good one.
Have a good weekend, guys.
Yep. Take care.